Well, with the ongoing U.S. conflict in Iran, increasing costs of oil, should you buy the dip? This is something should be talking about the last few days as the market suddenly took a little hit, if you will. To answer this question, I'm joined by Vice President of Wilsey Asset Management, Mr. Chase Wilsey. Mr. Wilsey, good morning to you, sir.
Good morning.
Is this conversation late now because the dip seems to have evaporated?
Yeah, I mean, the dip has kind of evaporated. We are right back near all-time records for the S&P, close on the NASDAQ as well. Dow Transport's doing well. So, I mean, the thing that you look at is dip buying has really been the name of the game really for about the last 10, 15 years. Anytime there's a pullback, it snaps right back.
Give me a little education here. When I hear all the money people around me talking about, well, the market is overvalued, what do they mean by that?
Yeah, and that is what I look at is the earnings multiple on the S&P 500.
Teach me about that.
So what we look at here saying is how much are you paying for the earnings of the S&P 500? You know, there's the it's 7,000. A number means nothing at all unless you have something to compare it to. We want to say how much are you paying for the earnings of the businesses that you're buying within the S&P 500. It has now climbed back above 20 times. The reason that number is important is over the last 20 years, it is about 20% above that average. So it is a very expensive market. The other big problem I look at, you look at what we call price to free cash flow. Now, earnings are a great way to value it. Free cash flow is another way to look at it. The big reason free cash flow has gotten so important is all of these big tech companies piling money in to AI. It's not a hit to earnings because you depreciate a lot of those capital expenditures, but you still have to outlay the cash for these data centers, for these chips, for all of those long-term kind of capital expenditures. If you look at the price to free cash flow ratio, we're now around 28, 29 times. That's over 40% above the 20-year average. So the reason I bring this up is the market is expensive. You used to be able to buy the dip, and when you bought the dip, you were paying 10, 12, maybe even 15 times the future earnings. But now at 20, you're not getting the same value as you used to.
All right, so we have to wait for our next conflict, be it the Strait of Hormuz or whatever. We have to wait for our next dip. My problem, and I'm a bit player, so I don't want to sound like I'm Rockefeller over here, but as a bit player, and I think for most people are kind of like me, you want to buy the dip, but then how do you do that? Do you take out money against your home, or do you sell off some of your portfolio? And then what good are you if you're selling off your portfolio to buy the dip? How do you have the money on the side to buy the dip?
I mean, the easiest way to buy the dip is obviously if you're still in your working years, you're still saving money, you still have your 401k contributions, you don't want to panic and sell during these dips. You want to still be adding and buying the dip when things go down. You're getting things on sale many times. But if you are in retirement, that is where things change. Many times you have your portfolio allocation in place. This is why we tell people not to get too risky near those retirement years because, as you said, it's not really that possible to buy the dip unless you want to mortgage your house, which I wouldn't recommend that for most people. That's a very risky strategy.
When I buy the dip, I'm usually talking about guacamole.
Yeah. And the big thing I just want to make aware to people here is, I don't want to say stocks are a bad investment at this level. I do believe what we call your value stocks, many times your financial companies, your insurance companies, businesses of that nature, are going to do better over the next 10 years than maybe your tech stocks. Tech stocks have had a great run over the last 10 years. The S&P 500, you made about 14% a year over the last 10-year period. I think over the next 10 years, it might only be 5% a year. That's a very real possibility because of those valuations. So you just have to temper your expectations. You may have to alter the companies you're looking for. And again, the valuations you're paying for the businesses that you have in your portfolio.
We have to call it a conversation, young man. Thank you much for coming in. Thanks for the education.
Thanks for having me.
Chase Wilsey, everybody, from Wilsey Asset Management.